macro currency signals.
What I'm about to lay out isn't hype, and it isn't a fantasy built on wishful thinking. It's a chain reaction already in motion. Silver is sitting at the edge of something most people still refuse to see. The charts don't scream it yet. The headlines don't confirm it yet. But the pressure is there, building quietly, relentlessly, like a fault line before an earthquake. And when it moves, it will not move politely. It will not move in small, predictable steps. It will shock. Right now, most people think they understand silver. They think it's just another metal, something that goes up and down with the commodities cycle, something that lags behind gold, something that can be ignored until it does something interesting. That complacency is exactly what makes this moment so dangerous, because the biggest moves in history have always happened when the majority was distracted, comfortable, or convinced nothing extraordinary was possible. Silver is not just a commodity, it is a barometer of stress. It reacts when currencies wobble. It reacts when trust erodes. It reacts when supply chains fracture. And right now, we are living in a time where all of those forces are converging at once. Inflation has shifted from a temporary talking point to a structural reality. Debt has exploded across every layer of the system. Confidence in paper promises is thinning slowly but unmistakably. And silver is absorbing that tension like a coiled spring. Before we go any further, if this breakdown is resonating the way it should, make sure you're subscribed and that notifications are turned on. In environments like this, timing matters. Being early isn't a luxury, it's the edge. Drop a comment below and tell me where you're watching from and what time it is on your side of the world. This conversation isn't confined to one country or one market, it's global. And seeing how far this reaches says more than any headline ever will. Now understand what just happened. For years, the system has functioned on the assumption that stability can be engineered indefinitely. Rates were pushed down, liquidity was injected, markets were backstopped. The illusion worked because belief held together, but belief is fragile. It only takes a few cracks before the structure begins to show stress. Silver sits at the intersection of that stress because it is both industrial and monetary. It serves factories and investors. It powers technology and preserves wealth. That dual identity makes it volatile, yes, but it also makes it explosive under the right conditions. Let's talk about supply, because this is where the story becomes impossible to ignore. Silver mining is not expanding aggressively. It cannot. The easy deposits have already been tapped. New projects take years to bring online. Costs are rising. Energy is more expensive. Environmental regulations are tighter. Grades are lower. This isn't a temporary bottleneck. It's structural. Production has plateaued in many regions while demand keeps marching forward. That imbalance is not theoretical, it's measurable. Now layer on industrial demand. Silver is not sitting in vaults doing nothing, it's consumed. Solar infrastructure relies on it, electronics rely on it, medical technologies rely on it, emerging energy systems rely on it, and once silver is used in these applications, much of it is not economically recoverable. It disappears from the above-ground supply. That means every ounce diverted to industry tightens the float available for investors. Unlike gold, which mostly remains stored, silver is constantly being absorbed by the real economy. At the same time, retail demand has quietly strengthened. Physical buyers are not flashy, they don't make headlines every week, but they accumulate, ounce by ounce, coin by coin, bar by bar. Every time physical silver is removed from the market and stored away, it reduces liquidity. That removal might seem insignificant in isolation, but collectively, it compounds. Physical metal cannot be conjured out of thin air. It cannot be printed. It cannot be digitally fabricated. Once it's gone from circulation, it's gone. And here's where it gets uncomfortable. The paper market for silver is enormous compared to the physical supply. Futures contracts, derivatives, leverage positions, layers upon layers of financial claims stacked on top of a relatively small pool of tangible metal. Most of the time, that system functions because not everyone demands delivery at once. But if confidence shifts, if physical demand accelerates while supply tightens, that paper structure begins to strain. Leverage amplifies everything. A modest upward price move can force short positions to cover. Covering triggers buying. Buying pushes price higher. Higher prices trigger more covering. This feedback loop is not hypothetical. It has happened before in various markets. The difference now is the macro backdrop. Debt is higher, currencies are weaker, policy tools are limited. The margin for error is razor thin. A squeeze in silver would not happen in isolation. It would ripple outward into gold, commodities, equities, and currency markets. Think about what that means. Silver isn't just positioned for a rally, it's positioned for a shock, a rapid repricing. A moment where price jumps not because of gradual optimism, but because the system suddenly realizes supply is tighter than assumed and leverage is more dangerous than admitted. Those moments are chaotic. They don't wait for retail investors to get comfortable. They don't offer polite entry points. They punish hesitation. And the broader economy is not stable enough to absorb shocks gracefully. Global debt has climbed to levels that would have seemed unimaginable a generation ago. Governments are stretched, corporations are leveraged, households are squeezed by rising costs. The entire structure rests on continued confidence in fiat currency and manageable interest rates. If inflation proves stubborn, rates cannot fall easily. If rates rise, debt servicing becomes painful. It's a trap. In that environment, silver becomes more than an industrial input. It becomes a pressure valve, a hedge, a refuge for those who sense instability. Historically, tangible assets outperform when trust in paper falters. That pattern has repeated across centuries and across continents. It isn't ideology, it's observation. When systems strain, people gravitate toward what cannot be inflated away. Some will argue that silver has disappointed before, that it has failed to sustain breakouts, that it is too volatile. And yes, volatility is part of the story, but volatility cuts both ways. What drifts quietly for years can surge violently when conditions align. Markets often compress before they expand, they coil before they spring. The longer the compression, the sharper the release. Right now, the compression is visible in inventory data, in production stagnation, in industrial consumption trends, in persistent retail demand. It's visible in the disconnect between paper pricing and physical premiums during stress events. These are not random anomalies. They are signals. Timing is everything. By the time the majority recognizes a shift, the early phase of the move is often over. The price will not ask for permission. It will not wait for consensus. It will respond to imbalance. And imbalance is growing. This is why preparation matters. Not panic, not reckless speculation, preparation. Understanding the structure of the market, recognizing the interplay between supply constraints and macro instability, being positioned before momentum becomes obvious. Because when silver moves under true systemic pressure, it does not drift upward in a gentle slope. It gaps, it accelerates, it forces revaluation. There's also a psychological component that cannot be ignored. Markets are driven by human emotion layered on top of fundamentals. Fear of missing out can be as powerful as fear of loss. When headlines finally shift tone and the public narrative changes from indifference to urgency, demand can surge rapidly. Retail buyers who hesitated for years suddenly rush in. Institutional traders adjust exposure. Short positions unwind. The shift from apathy to excitement can happen in weeks, not years. And once momentum builds, it feeds on itself. Price validates the thesis. Validation attracts attention. Attention attracts capital. Capital drives price further. That cycle is self-reinforcing until exhaustion. The early stage is quiet. The middle stage is explosive. The final stage is euphoric. Most people only notice the middle and the end. The opportunity lives in the quiet stage. Right now, we are in that quiet tension. The system feels stable enough on the surface to lull observers into complacency. Yet beneath the surface, inflation persists, debt accumulates, supply chains remain fragile, geopolitical tensions simmer, and monetary authorities have limited room to maneuver. Every one of those factors individually might be manageable. Together, they create fragility. Silver thrives in fragility. It thrives when trust erodes incrementally until it suddenly snaps. It thrives when real assets are reassessed against depreciating currency units. It thrives when industrial demand collides with investor demand in a tightening supply environment. And this is why the phrase, "about to do the unthinkable," is not exaggeration. The unthinkable is simply the moment when the majority realizes the minority was right about scarcity, leverage, and systemic strain. It's the moment when price adjusts not slowly, but violently, to reflect reality. Preparation does not guarantee profit, but lack of preparation almost guarantees regret. Waiting for certainty in markets like this is a losing strategy. Certainty only arrives after the move has already begun. Discipline, patience, and awareness are the real advantages. The coming shift in silver will not be driven by hype alone. It will be driven by math, by supply that cannot expand quickly, by demand that cannot easily contract, by leverage that cannot unwind smoothly under stress, by currencies that cannot maintain purchasing power indefinitely under mounting debt. This is not a prediction of a specific date. It is recognition of conditions conditions that historically precede large moves, conditions that are intensifying rather than easing, conditions that suggest the current pricing does not fully reflect underlying risk, and when that mispricing corrects, it will correct decisively. The window between normalcy and realization will be narrow. Those who have positioned themselves thoughtfully will watch the acceleration with composure. Those who dismiss the signals may find themselves scrambling. Silver is not asking for attention. It is demanding respect. It is quietly aligning with macro forces that have toppled overconfident systems before. The convergence of constrained supply, relentless industrial use, rising retail accumulation, elevated leverage, and global monetary fragility is not ordinary. It is rare. Rare setups produce rare outcomes. Right now, the choice is simple but uncomfortable. Ignore the tension because it hasn't erupted yet, or recognize that the storm forms before the thunder is heard. The market does not reward comfort. It rewards preparation. And if the coming shock unfolds the way the structural pressures suggest, silver will not just move. It will redefine assumptions. It will challenge complacency. It will remind the financial world that tangible scarcity cannot be permanently suppressed by paper claims. This is the stage before the shift, the calm before repricing, the quiet before acceleration. Silver is coiled. The system is stretched. The imbalance is real. And when release comes, it will not whisper. Now let's zoom out, because what's coming isn't just about a metal. It's about a financial system stretched to its limits. Silver doesn't explode randomly. It moves when pressure builds beneath the surface, and that pressure is everywhere right now. The global economy is overloaded with debt. Governments owe more than ever. Corporations are leveraged. Households are squeezed. Low interest rates masked the strain for years, but that era is fading. If rates rise, debt becomes unbearable. If rates stay low while inflation runs hot, currencies lose purchasing power. Either path creates instability, and instability is where silver thrives. Silver is unique because it benefits from both fear and growth. If industrial expansion continues, demand rises. If financial panic erupts, investment demand rises. Very few assets sit in that position. It doesn't need perfection. It needs tension. And tension is building. Inflation isn't just a temporary spike. It's embedded in the system through currency expansion, deficit spending, supply chain restructuring, and higher production costs. Once inflation expectations settle into behavior, they're extremely hard to reverse. Businesses raise prices in advance. Workers demand more pay. Governments struggle to cut spending. That cycle reinforces itself. When people begin to feel their money losing value, they look for something solid, something tangible, something outside the digital financial maze. That's when silver transitions from optional to essential. At the same time, supply cannot respond quickly. Mining takes years to expand. Energy costs remain volatile. Ore grades are declining. Environmental constraints are tightening. Meanwhile, technology, especially energy infrastructure and electronics, keeps consuming silver relentlessly. Industrial demand doesn't politely pause while markets debate price. This is what a structural squeeze looks like. Limited supply meeting persistent demand inside a fragile macro environment. Now add leverage. The paper silver market is significantly larger than the physical market. That works fine when confidence is high and delivery demands are low. But if physical demand tightens inventories while prices start climbing, leveraged positions can unwind fast. Short covering can trigger cascading buying. Momentum feeds on itself. Markets rarely move gradually once a squeeze begins. They jump, they gap, they shock. Stackers need to understand something important. Volatility will not be gentle. Even in a strong upward move, there will be sharp pullbacks. The market will try to shake conviction. If you're mentally unprepared, you'll react emotionally. And emotional reactions are expensive. Preparation is not just stacking metal, it's stacking clarity. Know why you hold it. Know your time horizon. Know what portion is long-term protection and what portion is tactical. Liquidity matters too. Smaller units offer flexibility. Recognizable forms move faster. Storage and access should already be planned, not figured out during chaos. Geopolitical fragmentation adds another layer. Trade tensions, regional conflicts, currency competition, all of it increases uncertainty. And uncertainty increases demand for tangible assets. When trust in policy weakens, metals strengthen. There's also the speed factor. Information now spreads instantly. If silver becomes a focal point of broader financial distrust, momentum could accelerate rapidly. Modern markets compress time. What once took years can unfold in months. But here's the critical part. The biggest moves begin quietly. They start before mainstream coverage flips bullish. They begin when positioning is still skeptical and liquidity still available. By the time the narrative shifts, price has already adjusted. This moment feels calm on the surface, but underneath, the ingredients are aligning. Constrained supply, industrial absorption, elevated debt, persistent inflation, limited policy tools, rising retail awareness. That convergence is rare. Silver doesn't need universal belief to move, it needs imbalance. And imbalance is here. When repricing begins, it won't ask whether people are ready. It won't wait for headlines to confirm it's safe. It will simply respond to math, to scarcity meeting demand in a stressed system. The real question isn't whether volatility will come. It's whether you'll face it positioned or scrambling. Because when silver finally does the unthinkable, hesitation won't be an option. And here's the closing truth you need to sit with. This isn't about hype. It isn't about chasing candles. It isn't about fantasy price targets. It's about recognizing pressure before it releases. Silver doesn't beg for attention. It waits. It tightens. It builds energy quietly while most people scroll past it. Right now, the system is stretched. Debt is heavy. Currencies are strained. Supply is tight. Demand is persistent. The pieces are on the board. When silver moves decisively, it won't send a polite invitation. It won't give everyone time to think it over. It will move because the math forces it to move. And in markets, math always wins eventually. The ones who prepared early will feel calm. The ones who hesitated will feel urgency. The ones who dismissed it will feel shock. This moment, right now, is the quiet before acceleration. The opportunity lives here, not in the headlines that come later. Stay alert, stay disciplined, stay patient, because when silver does the unthinkable, it won't be unthinkable anymore. It will be inevitable.